Hi, everybody, and Happy New Year. I hope everybody had a wonderful holiday. As we jump into 2025, we want to take a moment to discuss where we see the real estate market heading next year. In this presentation, I'm going to focus on our thoughts for the direction of mortgage rates, the financial health of the typical homeowner, inventory levels, and their impact on home sales and home prices. Now, in the interest of full disclosure, I am not an economist, nor do I play one on TV. We actually gathered this data from a number of sources to create this presentation. For the full slide deck, please check the description of the video. Okay, let's jump in and start with mortgage rates. But let's first talk about what drives mortgage rates. Contrary to popular opinion, it's not the Fed. It's really the expectation of inflation. As inflation increases, fixed income securities like the 10-year Treasury and mortgage rates need to increase to keep pace. So mortgage rates typically follow inflation and therefore the 10-year Treasury bond. And the spread between those two typically averages around 2%. Now, post-COVID volatility pushed the spread up above 3%, contributing to the elevated mortgage rates. As stability returns, the spread is narrowing, which will naturally ease mortgage rates. For 2025, the average 30-year fixed mortgage rate is forecasted to remain in the range of 6% to 6.75%. Q1 2025 is projected to be in the high sixes, and then rates are going to typically or slowly drop throughout 2025 and are expected to move in the low sixes by the fourth quarter. Comparatively, this is lower than the peaks that we saw in 2022 and 2023, but still higher than the pre-pandemic levels of 3% and 4%. It should be noted that forecasts are inherently uncertain, as economic conditions can shift. Last year, actually, economists predicted that rates would be under 5% by this year, by the end of 2024, which clearly did not materialize due to stronger than expected economic performance in 2024. Economists broadly agree that rates will stabilize in 2025, reducing volatility that has previously caused consumer hesitation. Stable rates encourage buyers to act rather than waiting for further dips. Next, let's take a look at the overall health of the homeowner. The overall health of the U.S. homeowner is remarkably strong, and the numbers provide significant context to counter some of the negativity surrounding topics like mortgage debt and foreclosures. Here's a summary of the main points. First, let's look at home equity versus mortgage debt. Yes, mortgage debt did hit a new high of $13.7 trillion this year, but we also have record equity levels. Homeowners are sitting on $35 trillion of home equity, far exceeding the $13 trillion in mortgage debt. This creates a substantial buffer and demonstrates financial strength. And as far as equity distribution, nearly 70% of homeowners have either paid off their mortgage or have at least 50% equity in their homes. This equity has been bolstered by double-digit appreciation since 2020. Every year since 2020, we've experienced double-digit real estate appreciation, giving homeowners significant flexibility. And mortgage delinquencies and foreclosures are at historical lows. Mortgage delinquencies and foreclosure activity are both at or below pre-Great Recession levels. The occasional percentage increase is more of a statistical anomaly than a sign of systemic stress. Unlike before the 2008 financial crisis, homeowners today have significantly higher equity and are less likely to face forced sales and short sales. Even in adverse situations like a job loss, they have options to sell and can extract that record level equity. Okay, we've all heard of the lock-in effect as far as mortgage rates go. This is a legitimate headwind, so let's talk about it. The average outstanding mortgage rate is 4.2%. Many homeowners are hesitant to move because their existing mortgage rate are so much lower than current mortgage rates. However, while this creates a slower churn in the housing market, life circumstances like relocations, family changes still ensure a steady stream of transactions. Homeownership decisions aren't solely economic. Personal milestones like marriages, separations, job changes remain critical motivators for buying and selling homes, ensuring continued movement in the market. Over time, consumers will adjust to higher rates as the new normal, much like they have in previous decades. And life circumstances will outweigh their financial circumstances of that lower rate, and they will make the decision to move. The U.S. homeowner is in a far healthier position than at any time leading up to the Great Recession. Despite some headwinds like higher rates, the combination of equity strength, low delinquency rates, and emotional motivators suggest continued resilience in the housing market. Okay, next up is home prices. The current housing market presents a complex set of dynamics. Over the past 5 years, we've seen impressive home price appreciation, around 60% nationally, with the East Coast topping out at nearly 65%. However, while this surge was initially a windfall for homeowners, it's also led to unintended consequences, particularly for first-time and lower-income buyers who have been priced out of the market. Many people have found themselves unable to afford homes, not just due to rising mortgage rates, but also because home prices have far outpaced income growth. That said, the market is beginning to normalize. Year-over-year appreciation is slowing down, moving from the double digits of recent years to a more modest single-digit increase year over year. This moderation is a good sign as it brings more stability to the market, reducing the volatility that we've seen in the past few years. However, this shift also comes with a tricky dilemma for potential home buyers who are waiting for those mortgage rates to drop. While 2/3 of home buyers say they are hoping to time their purchase for lower rates, there is a risk that home prices will continue to climb during this waiting period. Even if mortgage rates dip slightly, such as from 6.3% to 5.9%, the impact could be negated by price appreciation. For example, if a $450,000 home increases in price by 3%, the buyer may end up paying the same monthly payment even with a lower mortgage rate. So the potential benefit of waiting for rates to drop could be effectively nullified by price increases. In summary, while home price appreciation is moderated, the overall market remains delicate, with rising prices continuing to create challenges for both buyers and sellers. For prospective buyers, it's important to understand the full picture. Waiting for a drop in rates might not yield the anticipated savings if home prices continue to rise. So let's move to inventory and home sales. First, inventory. Looking ahead to 2025, the housing market continues to be shaped by a mix of challenges and improvements. One key issue that has persisted over the years is the shortage of inventory. While we are seeing more new construction, this issue stems from a long history of underbuilding, particularly following the Great Recession of 2008. During that period, many builders went out of business, and the industry failed to keep up with demand, leading to a gap in new housing supply that lasted over a decade. Fortunately, inventory levels appear to be improving, with a gradual increase seen since 2022. We're not yet back to pre-COVID levels, but the trend is positive. Home sales are also on the rise, and new listings have increased compared to the previous year, which is a good sign for the market. As a result, we're seeing a slight moderation in some of the more extreme seller conditions from the past few years. Buyers are no longer facing situations where sellers can waive contingencies and appraisals without issue. We're slowly moving back towards a more balanced market. We're not there yet, but we are moving towards it. So what are we thinking for home sales in 2025? Overall, total home sales, combining existing and new homes, are projected to reach about 5.1 million sales in 2025, reflecting a 10% increase over 2024. While this increase is modest, it signals that the market is trending in the right direction with more stability and a continued, albeit slow, recovery in inventory levels. In summary, the housing market in 2025 will be characterized by modest growth, ongoing affordability challenges, and a slow but steady recovery. It's not going to be a market of explosive change, but a more balanced one, which can still bring opportunities to buyers and sellers alike. And you have my commitment that I will always do my very best to make sure that as a company, we are always better tomorrow than we are today. And we will help you make 2025 your best year ever.